Welcome back, deep divers. Have you ever pictured transforming a neglected property into something really special? Or maybe building a brand new home from just an empty lot?
Mm.
Perhaps you're dreaming of expanding your rental empire, but, well, the idea of showing endless tax returns just makes you hesitant.
Yeah, that's a common hurdle.
Real estate investment is truly a world of opportunity, but let's be honest, navigating the financing side, it can feel like a bit of a maze.
It definitely can.
The right loan is often the crucial key, isn't it, to unlocking that next big move.
Absolutely. It's fundamental.
So today, our mission is to cut through all that complexity. We're taking a deep dive into flexible loan programs, designed for pretty much every real estate strategy out there.
Right.
Our sources today are a fantastic set of insights from Capital Flow Solution, and we're here to pull out exactly what you need to know to move fast, scale smart, and be genuinely well-informed.
And what's really striking when you look at these programs is just how specialized everything's become. It's definitely not a one-size-fits-all world anymore.
Not at all.
We'll explore how these different loan types are really tailored to very specific investment goals, hopefully giving you some practical shortcuts to making, well, truly strategic financial decisions.
Okay, let's kick things off with a classic strategy. One many investors, new and seasoned, know pretty well. The fix and flip.
Right, the classic.
This is for those of you eyeing those undervalued properties,
Yeah.
ready to roll up your sleeves, renovate, and then sell for a profit. It's a strategy that can generate, well, significant returns, but it often demands quick capital.
And quick execution, too.
Exactly.
You got it.
Yeah.
These loans are specifically designed to fund both the purchase, the acquisition, and the rehab costs. That's absolutely critical for investors looking to scale up fast.
No, not just the house itself.
No, you're getting the capital to actually do the value add plan, the renovation part.
Okay. And when we look at the details, the numbers, there are some really compelling features here. You can get up to 90% loan-to-cost LTC,
Mm-hmm.
which means the lender finances up to 90% of your total project costs, right? Purchase plus rehab budget.
Correct. Which is great for minimizing your upfront cash.
Absolutely. But here's where it gets, well, particularly powerful. Our sources highlight they offer 100% rehab financing. Now, what does that actually unlock for an investor? What are the practical implications there?
Yeah, that 100% rehab financing, it's a potential game changer for cash flow. It means once you've secured the property, you don't necessarily need to dip into your own personal reserves for the actual renovation.
Okay.
This frees up your capital, maybe to tackle more projects at once, or just to have a cushion for unexpected costs. However,
There's always a however.
there usually is. It's vital to recognize that while it frees up cash, it does mean you're operating with higher leverage.
Right. More debt relative to your equity.
Exactly. So a key insight here for savvy investors is that this makes your project timeline and sticking to your budget even more critical. Delays mean more interest-only payments, eating into your potential profit.
Okay, so discipline becomes paramount.
Absolutely. A robust project manager and a meticulous budget become, well, your best friends.
That's a really critical point. So, with that in mind, who is this kind of loan generally best suited for?
Well, we're talking about the classic residential flips. Could be a full gut rehab or just, cosmetic upgrades that really boost the appeal.
Got it.
Essentially, any short-term resale project where you're adding value quickly is a prime candidate. The loans are structured with shorter terms, typically 6 to 12 months, which aligns perfectly with that rapid turnaround strategy.
And what about eligibility? Do you need a long track record?
Well, our sources confirm these loans are open to both first-time and experienced flippers, which is great news for people starting out.
That is good news. But this raises an important question.
Right.
What's the sort of non-negotiable requirement for the property itself?
Okay, yeah. The property must show clear potential for value uplift through the planned rehab. It's not just about buying low and selling high, it's fundamentally about creating that extra value.
The lender needs to see that.
Precisely. They need to see that appreciation coming from your work. And critically, you need a solid exit strategy. That means either a quick sale after renovation or maybe a refinance into a longer-term loan if you decide to keep it as a rental.
Okay.
This isn't meant for long-term financing initially.
Right. So for you, the listener, the takeaway here is that fix and flip loans let you amplify your investment by leveraging the renovation itself.
Mm-hmm.
It allows you to focus your energy on that transformation, but remember that discipline in project management and having a clear exit plan are absolutely essential to turn potential into actual profit.
Well said.
Okay, so while fix and flip is all about speed and transforming existing properties, what if your vision is, well, bigger, creating something entirely new from the ground up.
Yeah, maybe you've spotted an empty lot with huge potential.
Exactly. That's a different beast entirely, isn't it?
Yeah.
Needs a different financial strategy.
Yeah.
So tell us about ground-up construction loans.
You've hit on it perfectly. This program is specifically designed for investors and builders who are constructing new residential properties. It's a highly structured, staged funding approach.
Stage funding.
Yes, it aligns precisely with the project's timeline, from the initial groundbreaking, digging the hole, all the way to the final finishes.
Okay.
Yeah.
And the terms must reflect that longer time frame, I imagine.
They do. You're looking at financing up to 85% loan to cost. So again, that's 85% of your total land purchase and construction budget combined.
Right.
But there's also a cap, up to 70% after repair value, or ARV.
Okay, ARV.
Yeah.
How does that ARV cap work, and why is it so important for managing these, often larger projects?
Good question. The ARV is the estimated value of the property after all the construction is finished and it's ready for sale or rent.
Okay.
That 70% cap means, let's say your finished home is projected to be worth $500,000. The total loan amount will be capped at $350,000, even if your actual costs may be pushed a bit higher than that on paper.
I see. It keeps things grounded.
Exactly. It ensures the project remains financially viable, with enough equity built in from the start, protects both you and the lender, really, prevents over-leveraging based on a perhaps optimistic future value.
Makes sense.
And the real sort of elegant part here is the draw-based disbursement instead of one big check up front.
You get money as you go.
Precisely. Funds are released in stages or draws. Like when the foundation is completed, you get a draw, framing is up, another draw, roof is on, another draw.
Okay.
This means the money aligns with the actual progress of construction, which significantly mitigates risk for everyone involved. And yes, these projects inherently take longer, so terms are typically 12 to 18 months.
Right. And what kind of projects are these typically used for?
Well, they're perfect for developing single-family spec homes, building a house to sell, or those small multifamily developments you see popping up in growing areas, and also maximizing infill lots in urban areas, turning those vacant parcels into hopefully vibrant new housing.
And eligibility. I'm guessing it's a bit stricter than fix and flip.
It is, as you'd expect. You absolutely need to have the land either owned outright or at least under contract, approved construction plans, a detailed budget, and having a qualified builder lined up. These are non-negotiable. They provide the clear roadmap.
The blueprint, literally.
Exactly. And just like with flips, a defined timeline and a strong exit strategy are crucial. Knowing how and when you'll complete it, and, importantly, monetize the property.
So if you're dreaming of breaking ground, understanding that draw-based disbursement, the ARV cap, is really critical, isn't it, for managing the project efficiently?
Absolutely. Making sure you have the funds exactly when you need them, and also ensuring you don't accidentally overbuild for the market realities. It's about building smart, not just building big.
Building smart. Okay, so sometimes an opportunity knocks and you need to act fast, like yesterday fast.
Happens all the time in real estate.
Right. Or maybe you're just in between long-term financing options and need a temporary solution to, well, bridge a gap. That's precisely where bridge loans come in. They're kind of like that swift, reliable friend you call in an emergency, maybe not the one you plan a long, drawn-out vacation with.
That's a perfect analogy. These loans are truly about flexibility and speed when timing is absolutely critical.
Okay.
They're a temporary solution to bridge a financial gap, whether that's closing quickly on a distressed property that demands immediate action, or maybe covering a period while you reposition a property before getting permanent financing later on.
And the terms reflect that temporary nature.
They do. They typically offer loan terms from 6 to 24 months, giving you that essential breathing room. And you can usually get up to 75% loan-to-value LTV based on the property's current appraised value.
Okay, LTV, not LTC this time.
Correct, based on what it's worth now.
Got it. And here's where it really seems to stand out.
Yeah.
Minimal documents required. That sounds almost too good to be true.
Well, it significantly speeds up the application and closing process. When time is money, which it often is in these scenarios, this can be an absolute game changer. It allows you to seize opportunities that maybe traditional lenders with their longer approval cycles might cause you to miss.
Payments.
Like fix and flip loans, they often feature interest-only payments to keep your holding costs lower during that interim period.
So what are the prime use cases then?
Their use cases really highlight this need for speed and flexibility. They're ideal for quick acquisitions when a deal just demands immediate action and you simply can't wait for traditional bank financing.
Okay.
They're also great for refinancing some other short-term debt, maybe to give you some breathing space, or just holding a property while you reposition it, maybe do some light renovations before you secure that permanent financing.
And eligibility, what's key there?
For eligibility, a solid exit plan is absolutely paramount, whether that's a planned sale or a definite long-term refinance strategy.
Because it's temporary.
Exactly. Bridge loans aren't meant to be permanent. The lender needs confidence in your plan to transition out of the bridge financing. And importantly, they must be for commercial or residential investment use, not your personal home.
Okay. The speed and minimal documentation are clearly the big draws here, but it sounds like there might be a trade-off. What should an investor be mindful of when leaning on the speed of a bridge loan?
You're absolutely right to point that out. There's usually a trade-off. While the speed and the ease are invaluable when time is really of the essence, bridge loans often come with higher interest rates compared to traditional, slower financing options.
Ah, okay. That makes sense.
So it's a strategic decision. You're essentially paying a premium for that immediate capital and that flexibility. The savvy investor factors that higher cost into their deal analysis from the start.
Right.
They understand it's an expense, but hopefully a short-term one, to secure an otherwise unattainable or maybe just a much more profitable long-term opportunity.
Got it. Pay for speed.
Mm.
Okay, moving on. For those of you out there building a rental empire, this next one sounds like a true game changer. DSCR loans. They focus entirely on the property's income potential, not your personal tax returns. How does this fundamentally shift things for investors?
Oh, this is a fantastic option, especially for portfolio investors and folks using LLCs. It fundamentally shifts the qualification criteria away from your personal income and tax history.
Which can be complex.
Right. And puts it squarely onto the income-generating ability of the investment property itself. The property essentially has to stand on its own financial merits, not yours.
Wow. That sounds incredibly powerful for investors looking to grow. So just to be crystal clear, no tax returns or W-2s required. How does that even work? And what's the real advantage for someone trying to scale up?
That's the headline, yeah. No tax returns or W-2s required in the traditional underwriting sense. Qualification is based solely on the property's ability to generate sufficient income to cover its debt service, the mortgage payment, taxes, insurance.
Okay, PITI.
Exactly. This frees you from the constraints of your personal income statements, which is a massive advantage for scaling. Think about it. Traditional lenders are often limited by your personal debt-to-income ratio, your DTI. That can really cap how many properties you can personally qualify for.
Right, you hit a ceiling.
You do. With DSCR loans, that constraint is largely lifted. It allows you to acquire multiple properties and build a portfolio potentially much faster. The lender is essentially looking at the property almost like its own little business entity.
That's a great way to put it. And the terms, LTV.
Right. You can typically secure up to 80% LTV based on the appraised value. The loan is then evaluated on something like the debt service coverage ratio, or DSCR, usually needs to be 1.0 or higher.
Okay, DSCR. For our listeners, what does that 1.0 or higher really mean in practical terms? And how might different property types, like maybe short-term rentals, influence that required number?
Good question. A DSCR of exactly 1.0 means your property's gross rental income just covers the mortgage payment and associated costs.
Break even.
Break even. Essentially, yes. Most lenders, however, prefer a buffer. They'll look for a DSCR of maybe 1.1, 1.2, or even 1.25, especially for certain property types.
Why a buffer?
It means the income generated is 10%, 20%, or 25% above what's needed for the debt payment. It provides a cushion against vacancies or unexpected expenses. Ah, okay.
And that buffer is especially critical for things like short-term rentals, Airbnbs, where income can fluctuate quite a bit seasonally. A higher DSCR signals a healthier, more resilient investment property.
So the ratio is like the property's financial report card.
That's a great way to think about it.
Yeah.
And a higher number often means better loan terms for you. These loans also offer long-term options, fixed rates or adjustable rate mortgages, ARMs, providing stability or flexibility depending on your strategy.
And the use cases seem pretty clear then.
Yeah, they're broad for anyone focused on income-producing properties.
Yeah.
Traditional long-term rentals, obviously, short-term rentals like Airbnb or STRs, and even acquiring or refinancing an entire portfolio of rental properties without going through that intense individual income scrutiny for each one.
Fantastic. Eligibility. Besides the DSCR?
Well, that minimum DSCR, usually 1.0 or slightly higher, is the core requirement. Also, having the title held in an LLC or some other business entity is generally preferred, sometimes required.
Why is that? It offers important liability protection for you as the investor, separating your personal assets. And honestly, it often simplifies the lending process because the focus is entirely on the business entity's asset, the property.
Right. So for you, the listener, the practical upshot of DSCR loans is less personal financial digging from the lender and a powerful focus purely on the performance of your investment property.
Exactly.
It's a huge advantage for scaling your rental business without your personal tax situation dictating your growth potential. Really helps separate your personal finances from your investment ventures.
It's a tool specifically built for that separation and growth.
Okay, so beyond these specific loan types we've explored, fix and flip, ground up, bridge, DSCR, our sources also highlight some compelling reasons to consider capital flow solution in general for these kinds of investor loans. If we connect this to the bigger picture, what truly sets a lender like this apart in what seems like a competitive landscape?
That's a great question because you're right. It's not just about what loans are offered, but who you're working with. These aspects really demonstrate, I think, an understanding of what real estate investors actually need to succeed day to day.
Okay.
Their secret sauce, if you will, seems to be largely in their efficiency and their specialization. They're focused.
Efficiency definitely sounds critical in real estate. Our sources specifically mention fast closings, averaging just 14 days, sometimes even 14 days. How do they manage that kind of speed when traditional lenders can sometimes take months?
Yeah, that speed is a huge differentiator. It's typically achieved through having their own underwriting in-house and just a very streamlined process focused only on these types of loans.
Specialization helps.
It does. They understand that a quick closing can literally mean the difference between winning a deal and losing it in a competitive market, missing out on a great opportunity because your financing is slow. That's a non-starter for serious investors. Capital flow seems built to eliminate that bottleneck.
Makes sense. And beyond just speed, they emphasize being investor-focused. What does that really mean in practice, this idea of built by real estate pros for real estate pros?
It generally means they speak your language. Many on their team likely are or have been real estate investors themselves.
Okay.
This translates into, hopefully, a deeper understanding of market needs, the sort of nuances of different deal structures, and maybe the ability to offer creative solutions that go beyond rigid bank requirement checklists.
Right.
They're looking for ways to make the deal work for you, rather than just ticking boxes on a form.
And their reach is impressive, too. Nationwide lending, active in 42 states and growing. For an investor, what's the real benefit of working with a lender that has such a wide geographical footprint?
It just means your opportunities aren't artificially limited by state lines.
Yeah.
If you find a fantastic deal in a hot market, maybe halfway across the country, you don't have to scramble to find and vet a whole new local lender you don't know.
Yeah, that saves time and uncertainty.
Exactly. That broad accessibility is key for scaling your business and maybe diversifying your portfolio geographically without adding unnecessary friction.
Okay. Our sources also address some common investor questions, FAQs basically, which I think further highlight that investor-centric approach. A lot of new investors wonder, do I need years of experience for a fix and flip loan? What's the reality there?
That's a very common concern, absolutely. And the answer seems reassuring. No, you don't necessarily need prior flipping experience.
Really?
Yeah. I mean, obviously, a solid plan, good comparable sales data for the area, and a clear understanding of your market always helps, right? But they say they've funded many first-time investors. They seem to be looking closely at the deal's merits and your strategy, not just your past track record.
That's a huge barrier potentially removed for newcomers. Okay, another common question. Can I get funding under my LLC? Why is that even a question people have, and what's the answer?
Well, it's a critical question for liability protection, keeping your personal assets separate from your business risks.
Yeah.
And the answer is a resounding yes. In fact, according to the source, all their loans are to business entities, not to individuals in their personal names.
Oh, interesting. It's required then.
It seems that way, yes, which is actually best practice for asset protection and really professionalizing your investment business anyway.
Good point. And finally, for those aiming to truly scale up, the big question, can I finance multiple projects at once?
Absolutely. The sources indicate that many of their clients are active, high-volume investors who juggle multiple concurrent loans. Their systems and processes are apparently designed to support that kind of significant scaling.
So you could have several projects going at once.
Yes, allowing you to have several projects in various stages, maybe acquisition, rehab, construction simultaneously.
Wow. These answers really seem to directly address some of the most common hurdles and worries an investor might have, don't they? Makes the whole process seem smoother, more flexible.
It definitely seems geared towards empowering investors to grow and pursue multiple opportunities without unnecessary roadblocks.
Phew. Okay, we've definitely navigated the ins and outs of fix and flip, ground-up construction, bridge, and DSCR loans today. It's really clear that the right financing isn't just about getting any money. It's about getting the right money, structured correctly for your specific vision and strategy.
Hmm.
Each loan type really serves a distinct, powerful purpose in a savvy investor's toolkit.
Indeed. We've seen how each program has its unique terms, its specific use cases, and those eligibility requirements all seem meticulously designed to empower different real estate strategies.
Right.
And understanding these distinctions, these nuances, is truly a shortcut to being well informed. It allows you to make strategic decisions that align perfectly with your goals, whether that goal is a quick profit, building long-term equity, or generating consistent cash flow.
So for you, the practical takeaway is this. Whether you're a first-time flipper just starting out, dreaming of breaking ground on a new build, maybe needing quick capital for a time-sensitive deal, or you're a seasoned portfolio manager building a rental empire, there's likely a tailored solution available to help you move faster and scale smarter. It's really about matching the right financial tool to the specific job at hand.
Precisely. The right tool for the job.
So as you reflect on these flexible loan programs, maybe consider this. What project are you dreaming of funding next? How might understanding these specific options unlock an opportunity that maybe you hadn't considered before, perhaps one that felt out of reach with just traditional financing?
Yeah, what kind of investor do you want to be?
Exactly. And which of these tools might help you get there faster? Lots to think about.
Definitely.
Thanks for diving deep with us today. Until next time, keep exploring, keep learning, and keep building.